The treatment of China by President Trump and his administration stands out against all other nations. Whereas Canada and Mexico were exempt from April 2's reciprocal tariff measures, having already been assigned country and industry-specific tariffs, an additional 34% tariff was imposed on China on top of the 20% country tariff already in effect. China's resolve and preparedness was clear in their swift and proportional response and accompanying messaging. The centerpiece of their retaliation was a matching 34% tariff on all US imports shipped to China. To highlight China's control over access to their economy, also announced were a number of niche strategic initiatives with respect to rare earths, anti-dumping provisions, and some agricultural goods. US President Trump then announced another 50 percentage point increase in China's tariff rate to 104% if China do not reverse course. President Xi doing so seems extremely unlikely. Instead, another proportional retaliation by China is expected against the US. China imposing tariffs on US imports in response to US's actions helps offset the growth effect of Chinese exporters' lost opportunity. US demand for Chinese goods is arguably less price sensitive than Chinese demand for US goods, given China's diverse range of local production. It is therefore probable that China will remain ahead in bilateral goods trade with the US, even with a 104% tariff. While not part of China's official retaliation, the promotion of local firms by China's government will also see US firms lose further market share for goods they manufacture in China. Chinese consumers buying Chinese EVs over Tesla's an obvious example. Still to come, likely very soon, are China's fiscal and market responses. The past 12 months has seen China take an increasingly active stance with economic policy, and the recent addition of extra capital to the major bank balance sheets, following an announced 1 percentage point increase in the deficit to GDP ratio for 2025, suggests broad-based fiscal and monetary support is being readied. Overnight, Premier Li Qiang made clear China has ample policy tools to fully offset any negative external shocks. It is also probable that the government will look to public and private balance sheets to stabilise and then strengthen the equity market, building confidence in household wealth and the availability of capital. This is fiscal and monetary capacity the US does not have, which history suggests can be highly effective for growth, particularly as Chinese consumers and many businesses held back on spending coming out of the pandemic, and in doing so, have accumulated cash for future purchases. We therefore continue to believe China can achieve its 5% growth target in 2025, principally by accelerating domestic investment and consumption. Into the medium term, the hit to US relations with the rest of Asia from the reciprocal tariff framework will give China much greater leeway to strengthen their economic and political relationships across the region and further afield. In stark contrast to the US's aggressive implementation of tariffs, China is offering financial capital and the know-how necessary for long-term economic development. This is an offer being taken up widely across ASEAN and Latin America, which have a combined population similar in scale to China's own, but with much younger demographics. It must be noted, though, that China strengthening its position in the world is also likely to raise the ire of the US, perpetuating geopolitical uncertainty and market volatility. All the more so if the US economy experiences a prolonged period of weak growth and domestic political uncertainty. It goes without saying that in addition to their economic and political position, China's dominance in global shipping, the global port infrastructure interests of Hong Kong and China, as well as China's holdings of US Treasury securities, are additional potential flashpoints with the US. These are wide-ranging risks which require regular, careful study. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.